2% of 5,000 is $100 silver. Michael Oliver says that we could go to 150 to 200 in Q2. You have about 1 billion ounces sitting in warehouses that are owned by ETFs, spot ETFs. They could empty all those out. See, the two biggest is SLV and PSLV. I think that's going to happen. But the one thing is they can only do that once. So what'll happen if they do that is the price of silver will drop probably 20, 25 bucks in a single day. They won't do it until silver's like 80, 90, $100. But when they do it, you can expect silver to drop about 20 bucks. But the problem is, once that 1 billion ounces is used up, it's kind of game over situation. Then you're looking at $500 silver. When they do that, even if silver prices crash $20, it's going to be a buying opportunity. What's the new floor for silver? You don't want to sell these gold and silver miners early in the cycle. We're early in the cycle. I'm not selling any stocks until we get to at least $5,000 gold, at least. If investors want 40% of silver supply, we're going to see shortages in silver. Now we have a two-pronged pressure valve on silver. 2% of 5,000 is $100 silver. So that's kind of my target area. I don't know if we'll get there. I think we'll be close though. We're looking at like $85, $90 is kind of if we look at a range. When gold goes to 5,000, silver will outperform gold. And right now, the silver miners have better margins than gold, right? Gold miners. And it's only going to get better. So I think that when gold goes to 5,000 next year, and we're at 4,400, so 5,000 is definitely kind of looking like a really good target. If we go $5,000 gold next year, we're looking at somewhere between 85 and 110 silver. That range, somewhere in there, kind of low end, high end range. Those numbers are stunning. You throw those numbers on silver miners, you're looking at some serious returns. And there's people out there right now that say that my targets of 85 to 110 are just silly low, right? Michael Oliver says that we could go to 150 to 200 in Q2. Those are numbers that they're mind-boggling. They make your head spin. But that's what we're looking at. That's the kind of...
The quiet detail here isn't the silver price target. It's the margin math almost no one is modeling correctly. At $85 to $110 silver, miner margins don't just expand, they structurally re-rate the sector, especially compared to gold miners already pricing in optimism. Michael Oliver's $150 to $200 projection sounds extreme, but it's rooted in momentum structures, not headlines. Meanwhile, gold near $4,400 already implies aggressive central bank stress. If gold reaches $5,000, the leverage inside silver miners becomes non-linear, not incremental. The market rarely prices that early. What Don Durrett hints at next is where timing, not targets, becomes the real risk.
And then we look at the other side of the coin, the bears. The bears think that silver has peaked here. And as my opening comment said, this has nothing to do with silver. This is all about gold and the drivers of gold. So if you say that silver is peaked out here because the RSA is to the moon and it's made this unbelievable rip over the last few months, it has to correct. Yeah, it'll correct. But like I said, my floor's probably going to be moved up to 50 bucks. And if it goes down there, that's just a little correction and turn around and go back up. The only thing that's going to end this bull market is the drivers of gold. And if we can talk a little bit about the drivers of gold, because that's the only thing that's going to break this silver market or gold market. It's not going to be a blow off top. It's going to be the drivers of gold, which basically move as investors. If gold flattens out or goes down, silver will flatten out and go down. That's just how it works. But right now, the drivers for gold are extremely good.
This is where most investors misread corrections as endings. Silver's pullbacks feel violent, but they're subordinate to gold's macro drivers: real rates, currency debasement, and sovereign risk. A $50 floor isn't bullish hype. It's a recalibration based on capital flows into monetary assets. Historically, silver never tops before gold flattens first. That relationship held in 2006, 2011, and 2020. Bears fixate on RSI while ignoring balance sheets and central bank demand. If gold's drivers stay intact, silver weakness becomes volatility, not failure. Next, Durrett will identify which gold drivers could actually reverse.
And those drivers, I think, are in place. They're not going away. I've been saying that we can expect 2 more years of bull market for gold, silver, and the miners. That's my expectation, 26 and 27. Now, a lot of people think it's going to go on a lot longer than that. I say that in 28, we have to be very, very cautious of this market ending, especially 29 or 30. So basically, the risk starts really ratcheting up in 27, 28, 29. But I'm pretty confident we'll get all the way to 28 before this massive run that we're in the middle of here. Early innings, it will end.
You had expressed some concerns about possible nationalization or confiscation of silver as we got into these higher prices, possibly. I believe you had mentioned like the ETFs being taken over or whatnot. Your take on as we approach, $70 silver and possibly $100 silver here. Are you concerned about nationalization of the metal itself or the mines at all?
Yeah, this is a question a lot of people have that are interested in. I've always said that nationalization is not going to happen because it's too difficult to nationalize your mines because you're going to lose foreign investments.
The overlooked signal here is not upside, it's the clock. Bull markets don't die from optimism. They die when policy shifts collide with crowding. His 2027-2029 caution lines up with historical tightening cycles after prolonged commodity booms. Investors ignore this because price feels permanent at highs. Nationalization fears make headlines, but capital flight makes them impractical. Governments know this. The real risk is policy creep, not seizure. Markets reward patience early and punish it late. In the next part, Durrett exposes where governments apply pressure without grabbing headlines.
The chances of nationalization to me is extremely low in just about every country. But what has high probability is higher taxes, higher royalties, and higher ownership requirements. Now, these aren't nationalizations, but they're kind of quasi-nationalization, is when they demand percent ownership of the mines. They're like, okay, and they've done this in a couple of ways. One of them is they've required local ownership. So a Canadian company goes into a West African country, 10% or 20% of that company has to be owned by locals, local ownership, not necessarily the government. And then other countries, they have like a free carry for like 10%, sometimes it's the project, not the company. A lot of times it's the project. So you have a 10% free carry to the country. So we're going to see more of those. And those they will bite us. Because depending on which country does. So if a country does it, every single miner that has a mine in that country will probably go down. And if they only have one, if they're a single mine company and they're in that country, they're going to go down substantially. Those examples are all going to happen.
This is how governments extract value without ever saying the word confiscation. Higher royalties and forced ownership quietly reprice mining equities overnight. Investors learn only after earnings miss. Countries like Chile and Peru already showed how fast sentiment flips once terms change. A single asset miner in the wrong jurisdiction carries asymmetric downside risk most portfolios underestimate. This isn't theory, it's a recurring pattern in commodity cycles. Political risk doesn't show up in spreadsheets until it's too late. Next, Durrett identifies which jurisdictions benefit shareholders and which ones slowly bleed them.
Now, as far as gold mining, that's kind of your risk for gold. One of your largest risks for owning gold miners, because your stock, if you pick you're only in 2 or 3 stocks, and one of your stocks gets one of these, higher free carries or higher royalties or higher taxes, then your stock's going to get whacked. And so as a gold miner, that's one of your highest risks. Now for silver miners, you actually have a dual risk, which is going to create a lot of volatility. And the dual risk is what you just laid out, or what I just laid out, as far as higher taxes, higher royalties, higher free carries, in tandem with shortages. So if we have shortages in silver, we're not going to have shortages in gold, but if we have shortages in silver, governments and regulatory bodies are going to take action. They're going to take action if you have shortages. They're going to find a way to create more inventory. And there's lots of different methods that they can do to increase inventory. The first one is what they'll do first is what they did in 1980, and they'll basically raise the margins. Like they raised them recently 10%, and they'll just keep bumping them up higher because margins have a huge impact on the players in the futures market.
The real risk isn't silver volatility. It's how fast regulators move when physical shortages threaten control. What's being said quietly here is that silver miners face political risk layered on top of supply risk, unlike gold, where above-ground stockpiles cushion shortages. As Don Durrett has noted, governments historically intervene hardest, where industrial dependence is highest, and silver is critical across energy and defense. The reference to 1980 matters. Margin hikes were used then to crush participation, not stabilize markets. A 10% margin increase can wipe out leveraged players overnight, distorting price discovery. For investors, this means minor volatility isn't random. It's policy-driven risk masquerading as market noise. And what Don Durrett explains next shows how far authorities are willing to go once margins stop working.
The future market has a big impact on the price of gold and silver. So if you keep raising those margins, you're going to end up pushing a lot of players out and pushing a lot of buyers out. Anybody who wants to buy on margin, fewer players are going to buy silver. So that will impact the price of silver going higher. So they're going to mess around with those margin requirements. The next thing that they're going to mess around with, but that's the low-hanging fruit. The low-hanging fruit, and after that we start to see things that are Six Sigma events that you don't expect. And the first one, it would be a regulatory situation where they don't allow people to buy. They only allow people to sell. They just one day they just basically say, okay, we have all these orders in, but all you can do is you can sell what you own. So, but they won't do this for a long period of time. It'll be a short period. But right now, we're not allowing any buy orders. No buy orders right now. They just lock it down. No buy orders. We're going to see, and there's probably a few other regulatory things they can do to create inventory.
This is where market mechanics quietly flip into outright control. Margin hikes are framed as risk management, but the real effect is removing buyers until prices stall or fall. Historically, futures markets dominate short-term price discovery, even when physical demand is rising, a contradiction most headlines ignore. The sell-only scenario sounds extreme, but similar restrictions have appeared during crisis events across commodities and equities. When regulators suspend buying, liquidity becomes one-directional, forcing price weakness regardless of fundamentals. For investors, this isn't theoretical risk, it's structural fragility built into paper markets. Next, Don Durrett shows how inventory can be created without mining a single ounce.
Then we get to what you mentioned earlier about the ETFs, that's another low-hanging fruit that I think is going to happen. You have about 1 billion ounces sitting in warehouses that are owned by ETFs, spot ETFs, and they can empty all those out. See, the two biggest is SLV and PSLV. Both of those, the G7 controls both of those. So the G7 could basically say, look, we have silver shortages. They need inventory. We got 1 billion ounces here. Let's basically make that inventory and sell those to the fabricators. And so what would happen, there's a few different ways they could do it. But basically, the inventory that they currently have, somebody would have to come up with the cash to pay off everybody that holds the paper, everybody that owns the SLV and PSLV. So we would all get cash, right? and then somebody be holding a whole bunch of debt and a whole bunch of inventory. So the governments would actually have to step in and loan them out the money. But it's actually not very much. It's actually peanuts. The U.S. government could basically say, okay, here are ETFs, here's the cash, we're going to borrow it to you. Then you sell the silver to the fabricators and pay us back.
This is the moment where investment demand quietly becomes emergency supply. ETFs are marketed as passive vehicles, yet here they're framed as strategic reserves, a critical contradiction. With roughly 1 billion ounces held across major silver ETFs, liquidation could temporarily relieve shortages without new production. As analysts like Durrett have long argued, ETF metal is not immune from policy pressure when industrial supply chains are at risk. The cash settlement mechanism matters. Investors get paid, but physical control shifts to governments and fabricators. For portfolios, this reveals that ETF ownership does not equal sovereign protection in a crisis. Next, Durrett explains why this tool works only once.
I think that's going to happen. But the one thing is that it's they can only do that once. So what'll happen if they do that is the price of silver will drop probably $20, $25 in a single day. They won't do it until silver's like $80, $90, $100. But when they do it, you can expect silver to drop about $20. But the problem is that's a one and done thing. Okay, you got a billion ounces. Guess else is going to buy those billion ounces? Is the investors are going to buy them. Directly or indirectly, somehow they'll get their hands on them. But the investors, their ears are going to perk up because their investors are going to go, oh, now there's no inventory because that was the last of it, right? Once that billion ounces is used up, it's kind of game over situation. Then you're looking at $500 silver. So my point is that when they do that, even if silver prices crash $20, it's going to be a buying opportunity.
This is the paradox Wall Street never models. Forced selling that accelerates long-term upside. A $20 to $25 drop sounds catastrophic until you realize it only happens at much higher price levels, potentially $80 or more. And once ETF inventories are drained, the market loses its last visible buffer, a point many analysts underestimate. Historically, sharp policy-driven sell-offs have marked accumulation zones, not trend reversals. If investors absorb that metal, future shortages become structural, not cyclical. For long-term portfolios, this reframes volatility as signal, not risk. And what Durrett's implying next is why silver's endgame looks nothing like gold's.
Silver was highly, highly undervalued. We had a GSR of 120. Now it's down about 65. But I said that, it's going to squeeze down over time. If gold keeps going higher, the reasons that are pushing up gold will eventually pull silver up. So silver is being pulled up as a monetary metal in conjunction with the drivers of gold. So what's pushing up silver is the drivers of gold. That's the main factor. Now, we also have these other factors, but those aren't the main factors. But those other factors kind of push silver up higher, faster. And those other factors is inventory levels. And that's where your fabricators come in and your investors start fighting over inventory. So you got 70% fabricators. That's basically silver going into some type of a product. And then you have 30% investors, approximately. It wasn't too long ago where it was below 25% investors, but now it's kind of jumped up to about 30. So now there isn't a lot of excess silver. As a matter of fact, we've had deficits for the last 3 to 4 years.
Silver's move isn't speculative. It's mathematical, driven by gold's momentum and tightening supply. A gold to silver ratio collapsing from 120 to 65 signals structural repricing, not trader enthusiasm. As analysts like Durrett have pointed out, silver historically lags gold, then accelerates once monetary demand spills over. What's different now is the inventory split. Roughly 70% of silver is consumed by fabricators, leaving a shrinking pool for investors. With investor demand already rising from under 25% to around 30%, deficits over the last 3 to 4 years matter far more than headlines suggest. This is a squeeze formed by arithmetic, not emotion, and it leaves little margin for error. Next, Don Durrett explains why those deficits quietly hollowed out the market.
The above ground silver has the amount of silver that's mined on an annual basis has not been enough for demand. So we've had to use above ground inventory to offset those deficits. And that has been slowly hollowing out the inventory of silver. So while gold is pushing, the demand for gold is the reasons for gold going higher that are turning silver into monetary metal, making it more demanding for investors, creating this competition between fabricators and investors over who gets the silver. And I've said, I wrote this in my book back in 2010, we are going to see shortages in silver because it's just a matter of time before the investors want some. When the investors want some. So the investors want 80% of gold supply, and currently they want 30% of silver supply. If investors want 40% of silver supply, you're going to have a shortage. So I've always believed that we're going to see shortages in silver. And so now we have a two-pronged pressure valve on silver, which I've explained. The first one is silver basically following up gold because of the monetary reasons, because of the drivers of gold.
This is the part most analysts gloss over. Inventory was sacrificed to preserve price stability. Annual mine supply hasn't met demand, forcing above ground silver to plug the gap year after year. That quiet drawdown matters because once inventory is thin, price suppression loses effectiveness. The comparison is telling. Investors absorb roughly 80% of gold supply, but only about 30% of silver today. If that rises to just 40%, as argued here, the market mathematically breaks. This isn't a forecast, it's basic supply math that contradicts calm pricing narratives. Investors should recognize this pressure valve doesn't release gently. What Don Durrett lays out next defines where prices can't fall back to.
You have that driver pushing up gold, and now we have inventory levels also pushing up silver. So the question is, what's the new floor for silver? I had the floor at $45 2 weeks ago. If we close this Friday, we probably will, above where we're at now, 68, somewhere in there, I will move my floor up to 50. So the floor keeps rising. And as the floor rises, that really helps the silver miners. Because if you have a $50 floor, that's going to create a lot of incentive for silver miners to basically spend more money to get silver out of the ground. And it's going to create a lot of incentive for companies to do acquisitions, to take advantage of these high margins. At $50 silver, the margins are plenty high. We're looking at about 40% margins at $50 silver, somewhere in there. Maybe not quite 40, maybe 35, but those are sufficient to make money. And it's at $65 silver, you have 50% margins, which are higher. Those are better than gold miners right now. So gold miners at $2,200 you'd have to have for 50%. You'd have to have $2,200 margins. We're not quite there. We're more like 45%, maybe 48% margins on gold miners, average. But gold miners, silver miners right now as we speak, are better than gold miners, which is stunning.
The rising floor matters more than the headline price. It changes behavior across the industry. When the floor lifts from $45 to $50, capital decisions change almost overnight. At roughly 35-40% margins, silver miners can fund expansion, acquisitions, and exploration without financial strain. That compares favorably to gold miners, whose margins near $2,200 gold sit closer to the mid-40% range. The contradiction is striking. Silver miners now offer better economics, yet remain less owned institutionally. For long-term investors, floors, not peaks, determine survivability and compounding. And next, Don Durrett explains why patience outperforms timing here.
You don't sell early. I love the Peter Lynch line where he said, Peter Lynch is probably the best investor of all time on performance. And Peter Lynch said, my biggest mistake, I don't know how the best of all time can have a biggest mistake. But he said, my biggest mistake was selling too early. And that's what I've been trying to tell people. You don't want to sell these gold and silver miners early in the cycle. We're early in the cycle. I'm not selling any stocks until we get to at least $5,000 gold, at least. So wait till $5,000 gold, and then I'll look around and say, okay, is it time? So what I'm waiting for is the market the cycle to at least mature a little bit. We need to at least get to the fourth or fifth inning. And until then, it's not, in my opinion, you can make money when you buy and you can make money when you sell, but you can make a mistake selling.
This is where discipline beats intelligence. Most gains are lost to impatience. Peter Lynch's warning matters because cycles punish early exits more than late ones. If gold hasn't reached $5,000, the monetary cycle hasn't matured by historical standards. Selling miners early sacrifices operating leverage just as margins expand. Investors often underestimate how much upside occurs in later innings, not the opening rally. The real risk here isn't drawdowns. It's abandoning positions before the thesis fully plays out. Next, Don Durrett explains how concentration turns patience into exponential returns.
But the other thing is you don't want to not take profits, but you want at a certain point, but you want to at least get the stock a little bit mature. So I'm not in the camp that take profits early just because your stock doubled, tripled. I have a stock right now that's a 30 bagger, and I haven't taken any profits, and I'm not going to take any profits until it's a 65 bagger probably. And so, I'm just, basically I want to take that initial investment. I want 2 or 3 of my stocks to pay off my entire cost basis. That's my plan. And right now I'm on track for that. And so there's no way I could do that if I take profits in them. And so I'm on track right now for 50 10 baggers.
This strategy isn't reckless. It's mathematically selective. Letting winners run isn't about ignoring risk. It's about a symmetric payoff. A single 30 bagger can distort portfolio outcomes more than dozens of small trades. By targeting a few positions to repay total cost basis, capital becomes effectively risk-free thereafter. Most investors never experience this because they trim too early. Concentration combined with patience is uncomfortable, but it's how outsized returns actually occur.